Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Alibaba Group Holding Limited annual report. Alibaba Group Holding Limited offers a wide range of businesses and services to its users and customers. At the core of its operations are digital retail platforms such as Taobao and Tmall, which provide e-commerce solutions for merchants, brands, retailers, and other businesses. The company also operates wholesale marketplaces through 1688.com and Alibaba.com, catering to international businesses. In addition to these platforms, Alibaba Group Holding Limited provides various services including e-commerce logistics solution through Cainiao, on-demand delivery and local services platform through Elemi, and mobile digital map, navigation, and real-time traffic information through Amap. The company also operates an online video platform called Youku, and offers content production, promotion, and distribution services through Damai Entertainment. Furthermore, Alibaba Group Holding Limited provides cloud computing services including elastic computing, storage, network, security, database, big data, and cloud-native solutions. It also offers hardware, software license and installation, and application development and maintenance services. The company sells membership packages and subscriptions to its users. In the entertainment industry, Alibaba Group Holding Limited operates a retail platform for groceries and goods called Freshippo, provides medical and healthcare solutions through Alibaba Health, and offers mobile games under the Linksy Games name. It also operates an online travel platform called Fliggy and a collaboration workplace and enterprise management platform called DingTalk. The company's innovative services include the Alibaba Token Hub, ATH Business, which develops multimodal foundation models, and the Ma-S business line, which builds AI technical infrastructure. Additionally, the QN business unit is responsible for developing a personal AI assistant. With its diverse range of businesses and services, Alibaba Group Holding Limited has established itself as a leading technology company in China and internationally. Alibaba Group Holding Limited market capitalization of 2,549 billion is significantly larger than the average industry peer of roughly 1 billion. This shows that Alibaba Group Holding Limited holds a significant advantage in their industry. Alibaba Group Holding Limited trades at a higher price-to-earnings ratio of 24 times and a higher price-to-book ratio of 2.06 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 40% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth for a company can be attributed to several key factors. One major driver is the increasing adoption of AI-related products, which accounted for 30% of external revenue growth and experienced 11 consecutive quarters of triple-digit year-over-year growth. Additionally, the integration of AI capabilities with e-commerce applications has led to significant growth in Cloud Intelligence Group's revenue. Another significant factor contributing to revenue growth is the expansion of quick commerce businesses, which saw a 57% year-over-year increase in revenue. The company's public cloud revenue also experienced growth, driven by increasing adoption of AI-related products and the execution of its Model-as-a-Service (MaaS) strategy. Furthermore, the onboarding of customers to comprehensive AI plus cloud products and services has contributed to revenue growth. The company's customer management revenue increased by 5% year-over-year, while excluding contra revenue impact, it grew by 8%. The quick commerce segment also experienced significant growth, with a 57% year-over-year increase in revenue. On the other hand, the primary drivers of revenue decline include investments in technology businesses, quick commerce, and user experiences. The disposal of Sun Art and In-Time businesses has led to a decline in revenue from certain direct sales businesses. Additionally, the decrease in adjusted EBITDA and income from operations due to these investments has contributed to revenue decline. The company's adjusted EBITDA decreased by 84% year-over-year, primarily due to investment in technology businesses, quick commerce, and user experiences. The disposal of Sun Art and In-Time businesses also led to a decline in revenue from certain direct sales businesses. Overall, the company's revenue growth is driven by its expansion into AI-related products and quick commerce, while revenue decline is attributed to investments in technology businesses and the disposal of certain businesses. Net income for the company experienced a significant fluctuation between 2025 and 2026. Initially, it increased by 96% year-over-year to RMB 23,502 million in 2026. However, this growth was short-lived, as net income decreased by 19% year-over-year to RMB 102,127 million in the same period. The decrease in net income can be attributed to several factors. One major reason is the impairment of intangible assets relating to Alibaba China E-commerce Group, which had a significant impact on the company's financials. Additionally, the adjusted EBITDA margin decreased by 1,200 basis points to 2% in 2026 due to investments in technology businesses and user experiences. Profit margins also underwent a substantial change between 2025 and 2026. The operating margin decreased from 12% in KON 2025 to a loss of RMB 848 million, $123 million in KON 2026, indicating a significant decline in profitability. Furthermore, the adjusted EBITDA margin decreased by 1,100 basis points to 7% in 2026. The increase in net gain from mark-to-market changes of equity investments and net gains from disposal of investments also contributed to the decrease in profit margins. Overall, the company's financial performance was affected by various factors, leading to a decline in both net income and profit margins between 2025 and 2026. The company's financial performance indicates a positive trend in its operating cash flow. For the year ended March 31, 2025, the company generated RMB 163,509 million in cash from operating activities. This significant amount of cash inflow is a testament to the company's ability to manage its operations efficiently and generate substantial revenue. The following year, the company continued to demonstrate its financial stability by generating RMB 76,213 million in cash from operating activities for the year ended March 31, 2026. Although this figure is lower than the previous year, it still indicates a positive operating cash flow, suggesting that the company's operations are profitable and generating sufficient cash to meet its needs. Overall, these figures demonstrate that the company is capable of generating positive operating cash flow, which is essential for its long-term sustainability and growth. The company's debt level and interest expenses have undergone some changes over the past year. According to the extracted summaries, the total debt increased from RMB 435.35 billion to RMB 476.4 billion, indicating an increase of 9.7% in total liabilities. However, this growth is not uniform across all types of debt. Non-current bank borrowings and non-current unsecured senior notes decreased by 4.3% and 3.9%, respectively, while non-current convertible unsecured senior notes increased by 56.1%. The company's interest expenses also saw a decrease, from $2,496 million in 2025 to $2,241 million in 2026, representing a decline of -4.7%. Despite these changes, there is no clear indication of a significant shift in the company's debt level or interest expenses overall. The performance of various segments and regions within the company has been mixed. On a positive note, Cloud Intelligence Group saw significant growth, with a 57% year-over-year YoY increase in revenue and a 38% revenue growth rate. Alibaba International Digital Commerce Group also showed improvement, albeit with a loss of RMB 138 million. Quick commerce business was another standout performer, experiencing a 57% increase in the same period. E-commerce business and China commerce wholesale business also saw modest increases of 4% and 8%, respectively. International commerce retail business reported a 5% increase, which grew to 9% by the end of the period. However, not all segments performed well. Alibaba China e-commerce group experienced a decline of 40% YoY, accompanied by a 40% decrease in adjusted EBITDA and a 44% drop in adjusted EBITDA. The All Others category saw an even more significant decline of 520% YoY, with a revenue decrease of 21% and increased losses of RMB 17,747 million. Management is optimistic about the company's outlook, citing several key areas of focus. The company plans to invest heavily in artificial intelligence, AI, and cloud technologies to strengthen its competitive advantages. This investment will also drive growth in customer management services and cloud business, while improving operating efficiencies across various segments. In addition to these investments, the company is placing a strong emphasis on research and development, with increased spending on personnel and technology infrastructure costs. This focus on innovation will enable the company to stay ahead of the curve in emerging areas such as quick commerce. Management expects continued growth, driven by increasing adoption of AI-related products and public cloud revenue growth. The company's financial position is also stable, with sufficient cash levels to meet its needs for at least the next 12 months. Overall, management's strategy is centered on investing in key technologies and areas of growth, while driving operational efficiency and innovation. The company has made significant investments in its infrastructure through various acquisitions. These include the purchase of computer equipment, data centers for cloud and e-commerce services, infrastructure for logistics and direct sales operations, and land use rights for corporate campuses and office facilities. In addition to these acquisitions, the company has also divested certain businesses to streamline its operations. Specifically, it has sold off its Sun Art and InTime businesses, as mentioned in page 23 of the report. The company has a history of paying dividends to its shareholders. In 2025, the company distributed two types of dividends: a regular dividend of $0.13,125 per ordinary share, and an extraordinary one-time dividend of $0.11,875 per ordinary share. This was followed by another regular dividend payment in 2026, also at $0.13,125 per ordinary share. There is no mention of the company engaging in share buybacks, indicating that it has chosen to distribute its profits directly to shareholders through dividends rather than repurchasing shares on the market. There are concerns about inventory buildup or supply chain disruption in several areas. A decrease in revenue from direct sales, logistics, and other segments under Alibaba China e-commerce group has been observed. This is particularly evident in the All Others segment, which saw a significant 520% year-over-year YoY decline in revenue. Furthermore, the All Others segment experienced a 25% decrease in revenue, which includes direct sales businesses where revenue and cost of inventory are recorded on a gross basis. This suggests that there may be issues with inventory buildup or supply chain disruption, potentially impacting Alibaba's operations and profitability. That concludes the financial summary for Alibaba Group Holding Limited. Feel free to comment below, and I will be happy to answer them when possible.